Imagine yourself on January 1st, 2014. The US unemployment rate finally returned to pre-recession levels after the 2008 financial crisis. Stock prices continue to rise, and the economy is getting back on track. But in the meanwhile, poker player Steve Cohen had to pay $1.8 billion in fines. A poker player from Great Neck, who everyone believed was a genius, evaded the S.A.C for over 20 years. He was using secret insider trading tactics to make his billions. It showed that Steve Cohen hadn't an ounce of respect for the law, just like the bankers who brought the whole economic system to its knees 6 years prior. In his youth, Steve discovered the secret that made him his fortune many years later. It's 1995, and a pregnant piano teacher and her husband, a dress manufacturer from Great Neck, New York, are working hard to make ends meet. The couple had 5 children to feed, and a 6th on its way. As a middle-class family, they enjoyed the post-war prosperity that arrived in the US. New cars, more jobs, and suburban houses. The Cohens were doing okay, but they didn't have a lot. Being the 3rd child in a family of 8, Steve claims that their parents didn't have a lot of time for most of their children. While that might have been true for the rest of the Cohen siblings, it wasn't for Steve. From a young age, it was clear that Steve was special. His parents treated him like a genius who would one day become rich. Living in a middle-class family and situated in a well-to-do neighborhood imbued this boy with ambition and hunger. He wanted to be rich like the neighbors. When he got to high school, Steve became a soccer player. With a high IQ, Steve excelled at most subjects. High school didn't pose a challenge for him, so he picked up some quote-unquote extracurricular activities. He and a few friends would get together after school, and they would play poker for hours and hours. Sometimes these tournaments lasted well into the night. The sessions were so long that the boys would end up playing all sorts of card games, as long as money was involved. Steve was so addicted to gambling that he recalls playing poker until 5:30 in the morning on the day of his SATs. Earning thousands of dollars per week gambling, Steve opened his eyes to all the available possibilities. He knew that the average 9 to 5 wasn't for him. He was making more in a week than his father earned in a month. Realizing that the real money is made on Wall Street, he became invested in business and economics. Steve Cohen applied to Wharton at the University of Pennsylvania in 1974. After learning everything he could about the world of investing, Steve was ready to conquer a new frontier. Only nobody expected what his next venture would lead to. Steve's friend exposed Steve to the world of trading, and he was hooked within the first minute. Steve took $1,000 out of his tuition money and used it to open a brokerage account. For him, the stock market was just a bigger poker table. There were global players, and he finally got a seat at the table. After graduating with an economics degree at Wharton in 1978, he applied for his first job as a trader at brokerage firm Gruntle & Co. With a small investment account, Steve began trading. Steve was working with the specialist for options arbitrate, Ronald Eisner. This investor wasn't sure if a newbie like Steve could successfully predict what the stock market would do in the short term. Still, a little voice told Eisner to give this young college graduate a chance. The first day, he made a profit of $4,000. Another $4,000 hit the account overnight, making him a profit of $8,000 on the first day at Gruntle. Eisner was shocked. But Cohen had a secret. Cohen was a tape reader. Before the digital revolution, there was a physical ticker tape. On this tape, you would have a live feed of all the orders coming in. Steve watched the tape like a hawk. Most of his associates and co-workers claim that Steve had a gift for spotting trends just by looking at the ticker tape. He would even factor in the available news and information on a stock and make the right decision. Basically, Steve was still playing poker, He was gambling. But it's not gambling if you're right. He had this gift, an intuition for trading that allowed him to make a ton of money. Eisner recognized his talent early on and allowed Steve to trade freely. In the first year, Steve made a lot of money. Eventually, he got so good at the game that at the height of his career, Steve was making $100,000 a day for Gruntle. By 1984, Steve headed a group of 6 traders and managed a portfolio worth $75 million. He would retain this group and his portfolio until 1992, when he left Gruntle to form his own hedge fund. But it wasn't sunshine and rainbows for long. All traders are looking for an edge, information that's public and recent that you can take advantage of before others find out about it. That's what we call the white edge. Then there's the gray edge, which is a bit of a slippery slope, meaning it's legal but frowned upon. And then there's the black edge. This is what we today refer to as insider trading. Insider trading is when someone with special knowledge about a company's secret information, like financial results or big plans, uses that information to buy or sell the company's stock. This is considered illegal and unethical because it gives them an unfair advantage over other regular investors. The 1980s was a period of mergers and acquisitions in the stock market. This happened during Ronald Reagan's presidency because the administration sought to increase business growth. All a trader had to do was find which of these companies would merge next, place a bet, and wait for the profits to roll in. Cohen was getting exceptionally good at predicting when these mergers would happen. In fact, he got so good that he attracted the attention of the Securities and Exchange Commission, or the S.A.C. In December 1985, Cohen bet that RCA and GE would merge. This happened well before the announcement, and the S.A.C. called him in for questioning. He refused to go, saying that he was invoking his right against self-incrimination. At this point, the S.A.C. was breathing down his neck. They saw that Cohen might have been using black edge trading practices to beat the market, as they call it. They were especially interested in his investments, which included Brett K. Lorry, but they couldn't find a thing. Cohen was off the hook, but not for long. In poker, it's said that one bad hand could wipe out all of your wins. Something similar happened to Cohen in 1987. You see, as hostilities in the Persian Gulf were increasing, interest rates were also rising, while the 5-year bull market saw no signs of slowing down. This put a lot of strain on the dollar. Couple all of this with the introduction of computerized trading, and you get Black Monday. On October 19, 1987, the Dow fell 508 points, or 22.6%, in just one day. That was the biggest single-day loss in the history of the stock market. Gruntle was almost wiped out. Even Cohen and his group of 6 savvy traders couldn't do anything against the giant tidal wave that crashed on the shores of Wall Street. During the crash, many companies failed. Gruntle was almost wiped out. They stayed afloat, but just barely. Steve learned a valuable lesson that day. Buy when blood is running in the streets. Instead of selling and getting scared, Cohen used his high IQ to remain calm and disciplined, while others were panicking. Going against the grain, Cohen started buying. Everything on Wall Street was between 10 and 50% off. Where everyone else saw a reason to be fearful, Cohen smelled the fear and used it against the investors. Gruntle survived, and for the next 5 years, Steve Cohen stayed with them, but he wasn't thinking of staying with them forever. It's 1992. Cohen, along with a group of investors, started S.A.C. Capital Advisors. After working 14 years for Gruntle, he had amassed a pretty big fortune. He used $10 million of his own money and another $10 million from his group of investors to start his first company. With $20 million invested and 9 employees, Cohen was ready to take on Wall Street. The hedge fund structure allowed Cohen to make a lot more money while removing restrictions. His trading strategy was complex. Figuring out how Cohen made his billions is difficult. One thing we can tell you for certain is that he never forgot the lessons of poker. Cohen's risk management strategy came from his long high school gambling nights. While most investors rely on sophisticated software, charts, and graphs, Cohen relied on his analytical brain. Never letting his emotions get in the way, Cohen would always kill a trade when it wasn't making money. Other investors have a hard time admitting they made a mistake. Cohen, on the other hand, had no problem making mistakes. What he hated was losing money. That's why he was emotionally detached from all his trades. Couple the cold-hearted risk assessment with his genius understanding of human psychology, and you get a recipe for an unbeatable investor. His company, S.A.C. Capital Investors, grew 400% in just 3 years. Cohen was making more money than he knew what to do with. So after 1995, he started spending. Lavish villas, old and expensive art, extravagant parties. He bought everything that tickled his fancy. Economists say the market is efficient. This means the price of stocks is fair, and only the lucky make a lot of money. Almost every person who trades stocks for short-term gain will lose. The market is efficient. There's no calculated anomalies. Ask any economist and they'll confirm this. Ask any successful investor and they will deny this theory outright. The market is efficient in the long term, but inefficient in the short term. People can make money trading short term if they're first, and yet somehow Cohen managed to win repeatedly. Short-term trades made him a billionaire. He was constantly beating the market. A high IQ explains only part of the success. The other part has something to do with the black edge discussed earlier. S.A.C. Capital Advisors' growth was unstoppable until 2009. At the end of the year, in December, Patricia Cohen, Steve's ex-wife, sued her husband and his brother Donald T. Cohen for racketeering and insider trading. But after 2 years of trying, the U.S. District Court in Manhattan dismissed the case. Cohen triumphed, and his ex-wife was left with nothing. This lawsuit, however, became the catalyst that blew up insider trading practices at S.A.C. and killed the company. After 2 years after the case was dismissed, on April 3, 2013, the U.S. Circuit Court of Appeals claimed that the Lower Manhattan Court made a mistake. They revived the lawsuit. Not only that, but they were also going to look at the racketeering claims and the breach of Cohen's fiduciary duty. During the trial, Patricia made the claim that her husband concealed $5.5 million in assets while they were negotiating a settlement for the divorce in 1989. While Cohen's wife was trying to prove her husband was hiding money, the S.E.C. was trying to prove that Cohen's company was involved in insider trading. Michael Steinberg, one of Cohen's closest friends and confidants, came under a lot of pressure. Before the S.E.C. could find out whether Cohen's hedge fund was doing insider trading, he and the S.E.C. reached a settlement. The deal was simple. Cohen pays $616 million, and in return, the S.E.C. will drop the lawsuits. This way, they could continue their operations without ever confirming or denying insider trading allegations. But Steinberg wasn't the only one involved in insider trading. On November 20th, 2012, Steve Cohen was involved in yet another insider trading scandal. This time, it was S.A.C. portfolio manager Matthew Martoma. 4 years earlier, in 2008, Martoma started building a large position in 2 pharmaceutical companies. The first one was Elan, the second was Wyeth. In 2008, S.A.C. had $14 billion in assets under management, and these companies looked promising. They were on the brink of developing a drug for Alzheimer's. Their future looked bright. Many investors believed that the stock price of these companies was about to skyrocket, but S.A.C.'s Martoma was shorting the stock. In other words, he was betting that the two companies would fail. Whenever Cohen was asked about his position, he would just shrug his shoulders and say Martoma knew a lot about the investment. Martoma did know a lot about the two companies, but it was thanks to this man, Dr. Sidney Gilman. On July 28, 2008, the two companies were supposed to release their drug trial results. Dr. Gilman knew the results were disappointing, while everyone on Wall Street believed they would be successful. Gilman took this information to Martoma, and the savvy manager made $276 million by shorting the stock. Just 4 years later, the S.A.C. came knocking. After a year and a half, Martoma was convicted in 2014. As the manager was headed to jail, prosecutors were calling this the most profitable conspiracy in history. Meanwhile, Dr. Gilman was free and served no prison time because he agreed to help the Securities and Exchange Commission capture Martoma. This lawsuit sent shockwaves across S.A.C. that reached Steve Cohen. The S.A.C. went after Cohen eventually, claiming that he failed to supervise two of his biggest fund managers. After 3 successful escapes from the grip of the law, Cohen was finally cornered in 2016. He then settled the civil case by pleading guilty. Steve Cohen then had to pay $1.8 billion in penalties, while being prohibited from managing other people's money or trading for 2 years. The $1.8 billion included the previous $616 million Cohen agreed to pay to the S.A.C. and a new fine of $1.2 billion. This settlement became so popular on Wall Street that it was borrowed and replayed almost in its entirety in the 6th episode of Billions Season 1. The only difference is Bobby Axelrod, who was modeled after Cohen, had to pay a $1.9 billion settlement, and instead of the 2-year ban, Axe was banned for life. Axelrod didn't stop trading though, and neither did Cohen. After S.A.C. Capital closed its doors in 2014, a new company started operations that same year, Point72. They transferred all the assets to Point72, and it seems like they also transferred most of their shady business practices. Cohen patiently consolidated the company and was building a team during the 2-year ban. He was quiet and flying under the radar, but as soon as the ban was lifted in 2018, Point72 started accepting new capital. New investors poured their money into Point72 until they could accept no more. In August 2020, Cohen announced that Point72 would not be accepting new money. And why would they? The company had $17 billion in assets under management. But just 1 year later, Point72 had to bail out Melvin Capital after the GameStop short squeeze. Melvin Capital planned on shorting GameStop. The company was run by Gabriel Plotkin, a former manager at S.A.C. Capital and was a close friend of Cohen's. During a short time, an investor borrows a stock from a broker. He agrees that after a set period, he will return the stock with interest. Immediately after getting the stock, the investor sells it and keeps the money. The investor is hoping that before the agreed-upon period is over, the price will fall and he can buy it back for less, return it to the broker with interest, and pocket the remaining profit. For example, you are an investor. You borrow a stock for $50 from a broker. You agree to give the stock back to the broker in 3 months plus $10 interest. After the broker agrees, you immediately sell the stock for $50. In those 3 months, the stock fell to $20. You buy it, now you give it back to the broker plus the $10 interest, and you will still pocket $20 in profit. This is exactly what they plan to do with GameStop, but Redditors in Wall Street Bets caught this short. They began buying GameStop stock and just held it. They knew that Melvin Capital would eventually have to return the borrowed stock for the short, and the only people they could buy it back from would be the Redditors. These buy and hold orders artificially jacked up the price to almost $500 a share, meaning Melvin Capital was done for. There was no hope of them buying the stock for cheaper like they originally planned. To save Plotkin and Melvin Capital, both Steve Cohen and Ken Griffith joined forces and paid $2.75 billion, $750 million of which came from Point72, aka Cohen's pockets. Plotkin's plan to artificially bring down the price of GameStop with the sheer volume of sell orders didn't work. A group of Redditors who bully themselves online outsmarted Wall Street veterans. After that major loss, Steve Cohen seemed to be moving away from the spotlight. Right now, he's the owner of the New York Mets, and he rarely appears in public. His net worth as of 2023 is $19.3 billion, and that's after paying $1.8 billion to the S.A.C. out of pocket and another $750 million to Melvin Capital. Right now, Steve Cohen, the highly intelligent high school gambler turned Wall Street trader, invests in art and sports. He seems detached from the world of Wall Street. That is, if you don't consider the fact that Point72 has between $26.7 and $33.6 billion in assets under management.